$10,000 a month in dividends. That's $120,000 a year in passive income. And if that number sounds too big or too far off, don't worry. This is a full blueprint you can actually follow. Nothing vague, nothing abstract. This is what I would do step by step to build a portfolio that could pay me that kind of income sustainably and for the long run. Now, let's be realistic. Getting to $10,000 a month in dividends isn't something that happens overnight. It's not some flashy one-year flip or crypto lottery ticket. It's a system you build, one that can be replicated by someone with patience, discipline, and a strategy, which is what I'm walking you through right now. So first, let's do the math, because understanding the scale of the goal makes everything else click into place. At a 6% dividend yield, which is a solid balance between risk and reward, you'd need about $2 million invested to generate that $10,000 per month. Sounds like a lot, right? But when you work backwards, it starts to feel less overwhelming and a whole lot more possible. If you gave yourself 10 years to hit that mark, you're looking at building a $2 million portfolio across 120 months. That's not impossible. That's just a puzzle waiting to be solved. And that's when the shift happened for me. I stopped looking at the total number like it was some massive wall I'd never climb. I started asking, okay, what's my monthly number? What can I actually control? Because you can't control market returns, but you can control how much you put in, how often, and how you build around it. That's where things got real. I sat down and ran a few different versions. What if I only had 15 years? What if I could only invest $3,000 a month? What if I started with a lump sum of $50,000 and added less aggressively? It all added up differently, but the outcome was always possible with enough time and consistency. The magic isn't in hitting $2 million overnight, it's in watching your dollars grow into that over time. And honestly, that first $100,000 is the hardest. It feels slow. Every month you're investing, maybe reinvesting dividends, and it doesn't feel like much is changing. But the moment that snowball gets rolling, things start to accelerate. I remember the first time I crossed $250 a month in dividends. It didn't seem like much, but I realized that was a utility bill, one bill I'd never have to earn money for again. Then it was $500, then $1,000. And suddenly, I wasn't imagining a $2 million end goal. I was stacking income, one step at a time. That's how I want you to think about it too. This isn't about rushing to the end. It's about hitting those meaningful personal benchmarks that build momentum. And if you're doing this right, those benchmarks show up faster than you expect. I also started tracking my yield on cost. That is, how much my original dollars were now earning as dividends grew. That number gave me so much motivation, especially when stock prices dipped but my income kept climbing. Because income is what matters here, not headlines, not daily market swings. And when you really grasp that, you start to tune out the noise. You focus on building the machine, one that pays you while you sleep, while you travel, while you rest. That's the mindset I carried into this process, and it made all the difference. The first thing I did when I got serious about dividend investing was sit down with a calculator and figure out how much I'd need to invest every month to get there. Assuming an average return that includes capital growth and dividends, say around 8 to 9% per year, you'd need to invest somewhere between $7,000 to $9,000 a month to hit $2 million in 10 years. For some people, that's doable. For others, it's a stretch. But remember, this is just one way to approach the timeline. If you had 15 years, the monthly investment drops dramatically. If you can front-load your contributions early, you buy yourself more compounding power later. But here's what I realized. It's not just about hitting $10,000 per month for fun. It's about replacing active income with passive income. It's about creating a financial system that pays me whether I'm working or not. So every dollar I invest today becomes a future worker that never quits. That mindset shift alone made me look at my money differently. Now, when it came to choosing a strategy, I had to be honest with myself. Am I someone who values income right now, or do I care more about long-term growth? That answer shaped everything that followed. There are 3 general approaches I considered: First is the pure dividend growth strategy. This involves companies that pay out smaller dividends, maybe in the 2.5 to 4% range, but grow those payouts year after year. Think companies like Microsoft, Visa, or Home Depot. These aren't income monsters today, but 10 years from now, those yields on cost could be incredible if the growth continues. And because they're backed by strong fundamentals, they tend to hold up well over time. The second route is the high-yield income path. These are stocks or funds that yield 8 to 10%, sometimes even more. The trade-off is they often don't grow much. Some of them might even be in declining industries. But if you're in a stage of life where income today matters more than total growth, these can work. I've used a few of these to accelerate my portfolio income in the short term. Covered call ETFs, business development companies, even carefully chosen REITs fall into this category. And then there's the hybrid path. This is the route I've ended up leaning into the most. I wanted a portfolio that gives me good income now, but also has the potential to grow over time. Aiming for a 5 to 7% blended yield lets me have both. So instead of chasing just yield or just growth, I found a mix that gives me flexibility and reduces risk. From there, I started building out the actual portfolio. I knew the core needed to be stable, foundational stocks that wouldn't give me heartburn every time the market dropped. About 50 to 60% of the portfolio is what I'd call the backbone. For me, that meant looking at dividend aristocrats and kings. These are companies that have raised their dividends for 25 to 50 years straight through recessions, crashes, wars, you name it. Names like Johnson & Johnson, Procter & Gamble, Coca-Cola, Pepsi, 3M, and McDonald's have consistently delivered. They're not flashy, but that's exactly the point. I didn't want excitement. I wanted consistency. I checked the payout ratios. I looked at their earnings growth. I made sure they weren't over-leveraged. These are companies that can keep paying, even when the economy slows down. And those steady payments are what let me sleep at night. I wasn't looking for home runs, I was looking for reliability. The kind of businesses that have already proven they can navigate tough times, evolve, and still reward shareholders year after year. I remember diving into their dividend histories and seeing how they kept paying, even during the 2008 financial crisis, even during COVID. That kind of resilience spoke louder than any earnings call hype. These weren't just dividend stocks, they were income anchors. I treated them like the foundation of a house. Sure, they might not grow as fast as a tech startup, but they also don't collapse when sentiment shifts or headlines go wild. What I loved was the predictability. You can almost set your watch to when they'll announce a dividend raise. It became a rhythm. Every quarter, another small paycheck that kept stacking. That rhythm gave structure to my investing. It took the pressure off timing the market or chasing trends. When everyone was panicking over rate hikes or inflation, these companies just kept doing what they've always done: sell everyday products, collect steady cash flow, and share a piece of that with shareholders like me. It's easy to overlook how powerful that is, but when you zoom out, these boring companies are often the ones holding entire portfolios steady during rough patches. And over a long timeline, that matters more than one-year performance. I also like that many of them had global reach. It's not just Coke in America. It's Coke in 200 countries. It's not just J&J selling baby shampoo. It's an entire ecosystem of healthcare, consumer goods, and pharma. That diversification inside the company added another layer of security to my portfolio. I didn't need to over-diversify with hundreds of random stocks. I just needed a handful of rock-solid ones that knew how to survive, adapt, and keep paying. That's what these companies are, and over time I realized I wasn't just buying shares, I was buying cash flow machines. Machines that ran whether or not I was paying attention. And that's the kind of investment that gives you freedom. When the dividends hit my account, they felt earned. Not because I worked that day, but because I set the system up to work for me. Then came the second layer, diversification. This made up about 30 to 40% of the portfolio and added more income and more reach. REITs were a big part of this layer. I personally looked into Realty Income, ticker O, which pays monthly and has a solid record. I also explored VNQ, a broader real estate ETF that covers a lot of ground. Real estate income adds a different kind of cash flow to the mix, and it tends to move a bit differently than tech or consumer staples. I also started adding some international dividend stocks. Companies like Nestle or Unilever gave me exposure to stable earnings in non-US markets. And for even broader reach, I used ETFs like IDV and VYMI to give me global dividend exposure with less individual stock research. Sector-specific dividend ETFs also played a role here. For example, I liked utilities for their stability, so I looked at XLU. I wanted some energy exposure, so I included a position in VDE. These ETFs gave me diversified cash flow without betting too much on a single company. But I wasn't done yet. The final layer was what I call the income accelerators. This is where 10 to 20% of the portfolio lives, the part that boosts returns when things are good but could be trimmed back when things get shaky. I tried covered call ETFs like JEPI and QYLD. These give high yields by selling options, which can limit upside but generate consistent income. I also looked into business development companies like Main and ARCC. These lend money to small and mid-sized businesses and pass most of the income back to investors. Now, not all income accelerators are created equal. Some are riskier than others, and I did my best to be careful. I avoided anything that didn't have a solid long-term record or seemed too good to be true. But this slice of the portfolio helped push my average yield up, especially in the early stages when I was trying to hit certain income milestones. Of course, knowing what to buy is one thing, knowing how to buy it is another, so I set up an implementation schedule. I didn't dump all my money in at once. I spread it out over 18 months using a dollar-cost averaging approach. That way, I bought during highs and lows without trying to time the market. Every month, I'd allocate a fixed amount into different slices of the portfolio, making sure my overall mix stayed aligned. I also built in rebalancing rules. Once a quarter, I'd check the allocations. If something had grown too large, I'd trim it. If something had dropped and still looked fundamentally strong, I'd add. And every time I added a new position, I'd ask myself, is this helping my yield target or just adding noise? If the answer wasn't clear, I passed. Maintenance became its own routine. Each quarter, I'd go through a checklist. Did any companies cut their dividend? Are payout ratios still reasonable? Are there better opportunities for yield with the same or lower risk? I also used tax loss harvesting when the opportunity showed up, especially in taxable accounts, to offset gains and improve overall efficiency. And when it came time to review actual results, I kept things realistic. I didn't expect the market to go up in a straight line. During the 2022 downturn, some of my holdings dropped in value, but the dividends kept rolling in. That's when I saw the real power of this system. Income didn't stop just because stock prices dipped, and since I wasn't planning to sell, I could just reinvest at better valuations. To give you a clearer picture, here's a rough breakdown of what one of my model portfolios looked like when I started building toward that $10,000 per month goal. I had about 55% in core dividend aristocrats and kings. These included names like Johnson & Johnson, PepsiCo, McDonald's, and Colgate-Palmolive. Average yield there was around 2.75%, but the growth was steady. Next, I had 35% in REITs, international stocks, and sector ETFs. Names like Realty Income, VYMI, and XLU brought in higher yield, around 4 to 5% blended. And finally, the last 10% went to income accelerators like GP, QYLD, and Main. These pushed yields into the 8 to 10% range, helping bring the portfolio's blended yield closer to my 6% target. Altogether, that portfolio targeted around $120,000 in yearly income once fully funded, $10,000 per month. And because it wasn't just based on one type of stock or one asset class, it had balance, not perfect safety, but a structure that could hold up across different markets. The one thing I'd remind anyone watching is this: none of this works if you don't give it time. The temptation to jump in and out, to second guess, to chase yield or hot trends, it's always there, but the results show up when you stick with the plan even when the progress feels slow. especially when it feels slow. If you're just starting out and can't invest thousands a month yet, that's fine. Start where you are. Even $500 or $1,000 a month adds up over time. The point is to start building the engine. Once you do, it's incredible how momentum starts to take over. I treated every dollar like a little worker that never sleeps, and those dollars started earning their own dollars. That's the real magic. Not some get-rich-quick fantasy, but a slow, steady system that one day makes it so I don't need to trade time for money anymore. This is the blueprint I followed. You can follow it too. If you found this breakdown helpful, make sure to like the video and subscribe. And in the comments, let me know. What's your current monthly dividend income? Or what's your first milestone goal? Whether it's $100, $1,000, or $10,000, tracking that progress is how you stay motivated. Keep building, keep compounding. You're closer than you think.